The roller coaster ride begins. Again, mortgage rates are shooting back up through the roof after cooling down at the beginning of the year for about 4 to 6 weeks straight. We looked like we were headed into tipping down below the 6% range on mortgages. And now it looks like we're going to surpass the 7% range at the pace things are going. In this video, I'm going to describe to you a little bit about what's going on with mortgage rates and the overall economy affecting it. And most importantly, I'm going to talk to you really quickly about how to manage your affordability to the best of your ability so you can stay in the housing market and continue to own more real estate. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm going to continue to drop content on a daily basis to help you customize your blueprint for prosperity. So, mortgage rates are going back up through the roof, slowly but surely, as if they already weren't rough compared to where they've been over the last 10 to 12 years. And in the last handful of weeks, mortgages have started to shoot back up. Now, the overall consensus is that eventually, if inflation continues to come down, even with rates going up, and the 10-year treasury and how direction that goes, that mortgage rates eventually will start to taper back down. Most economists and analysts feel this way. But at the moment, for the second quarter of this year, possibly the third quarter, who knows how far this is going to go, mortgage rates are probably going to hover up and stay up somewhere in the 6 to 7% range, which puts a lot of people in a tough position when it comes to affordability. You have to understand, when our economy is doing really well, lenders will make adjustments and raise their, loan limits and stuff like that. They will raise the, front end and back end ratios on how much home a person can afford. So if they say normally that a loan, requires a 36%, DTI front end ratio, when the economy is doing well, they may bump that up to 40% to be competitive and allow more people to be able to afford more home. When the economy is going into a dark place and, starting to contract, then mortgage companies will start to drop those same numbers and make it tougher for people so loan companies can be more conservative. Basically, when things are going well, then they will allow you to, they'll be more aggressive and allow you to pay for more home than you might normally pay for. When things are not going so well, then they may contest things, bring them down and become more conservative and squeeze people on how much they can afford. So with rates going up due to the economic circumstances, the federal funds rate, and other factors like the buying market, those of you who may be on the fence about buying a home are right in that balance where, hey, if it's below this rate or, somewhere in this range, 5 3/4 or 6%, I can afford a home. If it's 6.5, I can't. People who are in this range, please continue to keep the major impacting factors in account for in your ability to be able to put yourself in range to strike on a home. The biggest thing you want to focus on, keeping your credit in prime ratio. Ideally, 740, 760 or higher on a middle FICO score is going to usually get you in the best range for rates and benefits from that lender and approvals. You also want to keep your DTI in the best shape possible. We just talked about how lenders can loosen and tighten this requirement at a moment's notice based on economic circumstances. So you want to work hard to make sure that you are keeping your bills, your reporting bills and debts to a minimum so you can afford more monthly payment. You also want to keep strong, consistent, verifiable income. Very important. 2 years work history. W-2s appeal the most, but at least be prepared if you have 1099 commission, tip income, whatever the case may be, working business income. Have your tax returns together and be ready to prove 2 years of income to the best of your ability, or at least a year's worth of bank statements, in which case you might need to put more money down, but those loans do exist. Good cash reserves. The big four, the last one of that four is going to be good cash reserves. You're going to want to make sure that you have ideally at least somewhere between 3 and 6 months payments outside of the cost to close on the home. So if you need 3%, 5% down, and you might have 2 to 3% closing costs, you need that money. And ideally, you're going to need reserves on the side of another, 3 months, 6 months worth of payments. So these are the big four that are going to influence your affordability, influence lenders' comfort in lending to you. I want you to take these into account, do an audit on yourself, and make sure you're in the best position possible. And we're going to continue to stay updated as the market continues to fluctuate, hopefully helping you to own more real estate. As always, thank y'all for tuning in. I enjoyed bringing you this content. I know it was valuable for you. Like the video, comment your thoughts down below. Comment where you are in the housing market. Are you selling? Are you trying to buy? Where are you? Let us know so we can continue the conversation. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.